Mona, let's start with you. And certainly those jobs numbers really got our attention on Friday, were really dominant. What did they tell the markets?
Yeah, look, David, it's hard to really say that we're in a recessionary environment with jobs increasing over 500,000 this month. Now, keep in mind, the U.S. economy has started here from a position of strength. So while we could see weakening in the jobs figures, in earnings data in the months ahead, we certainly are nowhere near what we'd call an economic downturn or recessionary environment. Now, what were the market implications of this move? Well, you touched on some of them, but one thing we saw right off the bat, the expectations of a 75 basis point Fed rate hike really skyrocketed between yesterday and today. Yesterday's probability, 35%. Today, we have a 65% probability of a 75 basis point rate hike again by the Federal Reserve in September. The second thing we saw was, of course, those yields. So Treasury yields, both on the 10-year and the 2-year. Now, keep in mind, the 2-year tends to be a proxy of what the Fed may do in the next couple of years or so. Both skyrocketed higher. But we continue to have what we call an inverted yield curve. So historically, this inverted yield curve does provide a leading indicator of a recessionary environment, but there is some lag to it, 6 to 18 months. So net, we saw a market that absorbed this higher jobs figure, absorbed a potentially more aggressive Fed. But what we did see under the surface was that some of those growth parts of the market, longer duration, tech, speculative, higher valuation parts of the market, did underperform again today. And that might be a theme we see going forward as well.
So, John, Authers, you follow central banks all around the world all the time, including the Federal Reserve. Did the Friday numbers make the Fed's already difficult job harder, or did it make it easier?
I think it made it easier. I don't think myself that Powell tried to be that dovish last week. I think he meant to give the impression that he was still very much committed to a more hawkish series of rate hikes. He was open to the claim that he was just not credible for a while. The number of people who are convinced that the Fed will have to turn around swiftly because the economy will be too weak has been strong. That's been why we've had this really remarkable fall back down in yields. And with numbers like that, it's very hard to criticize them for tightening rates. There's obviously the employment picture could scarcely be stronger. There is really no good practical reason why they shouldn't be very aggressive in raising rates to cut inflation. So I think their job has been made simpler. I don't quite understand why the stock market is still very calm about this and still plainly in the middle of quite a strong bear market rally. That does surprise me. I thought the numbers we got today would have been enough to shake the stock market far more than it did.
Yeah, I want to come back to that. But first, Mona, let me ask you, do you think it's possible for us to have this kind of job growth and still get inflation under control? Or do we have to see a change in the employment situation?
Yeah, clearly we have to differentiate between headline and core CPI here and inflation expectations. So, of course, the headline number will be driven by what we see in energy and commodity markets. And we've been seeing a nice move lower really since the beginning of July, mid-June. We've seen oil, but not only oil, food, grain, industrial metals, all roll over to some extent, probably driven by concerns about global demand rolling over as well. On the core side, we're continuing to look at what we call shelter and rent inflation, but also services inflation. Both of those are stickier than we'd probably like to see, but the Fed has to continue to put pressure on the core part of the market, and keep in mind their preferred metric is core PCE, in order for them to meet this mandate. Now, what else we're watching, and the other good part of this story, is that we are starting to see inflation expectations and break-even inflation rates starting to come down from their highs as well. So inflation hasn't yet been anchored permanently higher, at least in the minds of consumers, which is something the Fed does watch. So in our view, we do think inflation will start to moderate, certainly on the headline side and also on the core side by year end. And we should start to see, even things like shelter and rent be impacted lower by inflation sensitive parts of the market, interest rate sensitive parts of the market, like housing, for example, but even ultimately like durable goods and services as well.
Well, that's the key question, isn't it? Some of those more durable factors in inflation. John, what about that? We're going to get CPI numbers next week, and you have things like owner rent equivalents and things like that.
Yeah, I mean, I would be surprised if we don't see some kind of a decline simply because in the year-on-year rate compared to last month, because gas prices really have come down very sharply from an extreme level. So the chances that we see a decline in the headline rate are fairly high. That's politically quite important. It doesn't really help the Fed that much at all. I think Mona's completely right to stress the rent issue. The problem with rents is that because of the way it's calculated, which we don't need to go into now, it tends to have a lag, and the likelihood is pretty strong that we've got quite a few more months of increases in rental inflation already baked in, and there is, again, this is one area where monetary policy will work. You make it more expensive to borrow to buy a house, and demand for houses will go down. You will see, I think, the Fed feeling obliged to keep hiking to control that area of the inflation. The other important point I want to make, though, is people get excited about whether the peak is in, understandably, but what really matters is how quickly it comes down. There's a very big difference between core inflation being back down to 3% by the end of this year, or it's still being at 5%, even though both would represent a decline. It needs to come down pretty fast, and if it doesn't come down very fast because of this concern about creating new baked-in inflation expectations, the Fed is going to have to be more aggressive than people are currently pricing.
Well, Mona, what about that? How fast do you expect it to come down, if in fact it does come down? And let me put one more thing in that there may be momentum behind, and that is salaries. The salaries went up 5.2% year over year in the numbers we got this week. At the same time, it's thought that they're kind of sticky. And there are a lot of people out there that are just waiting for the next raise and are going to expect something pretty big.
Yeah, absolutely. Look, I think the inflation rate we'll start to see, and to John's point, the year-on-year comparisons, and based on those base effects alone, we should see headline numbers start to move towards 6.5%. But will we reach that 2-3%? Probably not till at least mid-end 2023. But that could be driven by exactly to what John was talking about as well, that lag effect from a weakening housing market, potentially a softening labor market, and potentially just weaker demand globally. That should all put downward pressure on inflation and that core part of the inflation, which does take some time. And when we looked historically, takes about 2 years for inflation when it's above 5% to go from peak to trough. So if we did peak, last month, we may not reach trough until another 12 to 24 months from now. But if the direction of travel is in the right way, we could start to see the Fed at least take a pause at some point next year and assess the situation, assess the economy as well.
John, what about wages? Because we got those very strong employment numbers out. There was sort of a head fake, I thought, in some of the JOLTS numbers and the unemployment claims. What is going on? Are we seeing real softening in the labor market?
It's a very difficult one, isn't it? My best guess, because I, like everybody else, was surprised by today's numbers. The JOLTS number, I suspect, has come down simply because companies are beginning to fill those vacancies. I'm not sure that it's because they are already drawing in their horns and taking job ads down without ever having filled them, which was a popular explanation earlier in the week. But the bottom line plainly is that there's, I suppose with the claims, the notion there, although it's not fully borne out by the establishment survey either, is that more people are looking, that more people are trying now to get back into the labour force, and things are getting things are therefore showing up as more people claiming unemployment insurance, even though the overall numbers show a strong market. The wage inflation you mentioned earlier on, Andrew Bailey of the Bank of England, he got into a lot of political trouble for urging people not to ask for more, for higher pay, which he certainly would like it if people didn't get better pay rises. But it's utterly reasonable in times of high inflation to want a higher pay rise. It's a very difficult issue.